Here's a look at market recap for the day gone by. And after Tuesday's big rally, Indian markets today consolidated in a tight range, and they consolidated in line with global markets. For the entire trading session, large cap stocks remained extremely range bound, and Nifty moved in a narrow and a tight range of about 50 points. There was plenty of action in mid and small cap stocks, and that once again was the key highlight for the day gone by. In terms of the market movement, Nifty closed almost at the day's low. Small and mid cap stocks, they were relative outperformers. There was action in real estate stocks. Real estate has been a marked outperformer at least in the first part of July. Foreign institutional investors were net buyers in the cash market. And if you map what is happening with Asia, well, Indian markets today were also in line with other Asian markets. So what's the way forward for Indian markets? Tomorrow we have Infosys, TCS, IIP, and then outcome of the EGOM. So let's discuss the market direction, technical direction, and the fundamental direction with my two experts. Fani Shekhar with Angel Stockbroking, and Sandeep Wagle, he represents Aptat India. Gentlemen, good evening. Thank you for joining us. Sandeep, how would you characterize market action for the day gone by? Healthy consolidation after yesterday's big rally?
Yes, Nikunj, absolutely. I would talk of this as a consolidation. I would talk of it as a listless day actually. Nothing was happening. But I won't be ready to accept the fact that everything is over and we are on the way down. So consolidation is very, very painful because you don't know how many days it can go into sideways mode. Now in this case, after such a strong rally from the last 2 days, we may move sideways for the next 3 or 4 days. So possible consolidation. I would talk of a correction also, possibility that 5280, 5270. If 5250 is broken, then one has to talk of 5100, 5150. Till that time, I think we should talk of this as a consolidation in 100-point band.
Funny, if I map global cues and the local environment, things are challenging, but despite these obvious challenges, Indian markets are holding on. So what has done the trick for us, A? And B, is the current market rally reminding you of the kind of rally we saw earlier this year, which is in the month of Jan and Feb?
No, I guess the rally this time round is qualitatively different from what we had seen in the past, because in the past the rally to some extent had baffled us because there was no perceptible change in either the policy environment or the global macro, in the sense that while the concerns on Europe were still there, commodity prices, especially oil, were nowhere close to what we are seeing today. So while today there is some relief on global commodity prices led by oil, copper, zinc and others, at the same time the concerns on the European front are much lower than what they were last time around. And very importantly, on the domestic front, we are seeing at least New Delhi fighting a battle of perception and at least scoring some points to begin with. So whether it is the Vodafone tax case or the GAR guidelines which have been put on the back burner, I think it's a positive start. But investors at slightly higher levels of market, maybe closer to 5600, would start demanding more action than talk. And that is where you can see first signs of resistance coming in this market.
Funny, but if I split the institutional activity into two parts, domestic institutional activity versus foreign institutional activity. Domestic institutional investors have been net sellers and foreign institutional investors have been net buyers. So do you think somewhere global money managers or global fund managers are pricing in some hope, some positive news flow from New Delhi?
Well, it certainly seems so that the global investors are more hopeful than the Indian investors. And there is a reason to that, because first of all, I don't really understand where is this great cynicism that is coming afresh among domestic investors, because if any, I think the level of pessimism and cynicism should have gone a little lower. Having said that, one should also appreciate that domestic institutional investors are under different kinds of pressure, and some of that may be that might be related to redemption or seasonal factors. However, one can understand where global investors are coming from, because oil, which has been the main bugbear of India, has cooled off from a high of 125 to close to 100 today, and that by itself is giving some sort of a relief in the absence of other tangible measures that New Delhi must take.
Sandeep, technically, is the current rally reminding you of what we saw in the month of Jan and Feb, where it was money which made all the difference, and irrespective of profile, it's high beta which made a roaring comeback?
Well, to some extent, yes. I mean, every rally is supported by the inflows. But somehow I always felt that even this rally has a limited upside. I never talked of a 5600, 5700. I always talked of a 5350, 5400, possibly an extension to 5450, which I still maintain. I don't see the rally having the legs to go to the prior high of 5650, 5700. I don't think that will happen so soon. I see more of a painful consolidation in the range of 5100 to 5400, possibly 5450, and then it taking the Nifty spending some more time, possibly a month or two, and then a decisive move, and that should be with a positive bias. That is what my feeling. That is what at least the charts are suggesting as of now.
Funny, as of now, markets are pricing in some more disappointment from Infosys. Last quarter, they disappointed markets with a negative surprise. Do you think tomorrow they could surprise us again, but this time the surprise could be on the upside?
Any fundamental surprise looks extremely unlikely, especially in the context of dollar appreciating against all other currencies, and with Infosys billing about 40% in currencies which are not dollar denominated. So, strong cross-currency headwinds might actually entail a lower than guided revenue performance, and at the same time might also compel the company to tone down its already muted full-year revenue guidance. But on the other hand, there might be an upward revision of its rupee EPS guidance all the way up to maybe 175 or 177. So it might be a marginal positive for the Indian investors, but a lot depends on if the company would make something positive out of this rupee windfall that we are getting, either in the form of a special dividend or in the form of a buyback. If none of these two corporate actions take place, then I think on the balance, if they disappoint on the dollar revenue guidance, then Infosys might languish at these levels for some more time.
Well, it's already down 11% more, but bear in mind that closer to 2200, closer to 20 to 50, Infosys has a base in place. Sandeep Agle, would you agree with my assessment that closer to 2200, closer to 20 to 50, Infosys has a strong base in place?
I would agree, Nikunj. The prior bottom that it made in the last quarter of 2300, 2280, 2250 possibly should be held on, and unless there is something extremely negative which is not anticipated, I really don't think it will crack down one way. Yes, it may not move up one way, but somehow I feel that it will surprise us on the positive side, but a mildly positive side, not that it will run up from 2450 to 27, 2800. I don't have that view. Range bound between 2350 to 2500 for Infosys, and so for TCS in that 50-70 point range is what I feel.
Apart from Infosys and TCS, what else could influence your portfolio? Well, tomorrow we have a date with IIP. IIP numbers for the month of May will be released tomorrow, and according to ET Now poll, for the month of May, the IIP could clock a growth of about 1.7%. Movement in dollar index is also very important. What's interesting here is that Indian markets are suddenly outperforming global markets despite a flavor of global risk on, because if the dollar index is high and if other emerging markets are underperforming, this is more like India-specific outperformance, which is quite encouraging. And why are we outperforming? Well, the explanation is simple. It is largely because of foreign inflows. If you map how foreign institutional inflows have moved first in the month of June and then add with what we've seen in the month of July, they've been net biased to the tune of about $1 billion plus, which given the kind of global backdrop we are in, to my mind, that's very, very heartening. Funny, IIP numbers are also due tomorrow. Do you think in the overall scheme of things, IIP numbers or IIP data will not nudge the market needle much?
No, not much, because whether it is plus 1.5 or a contraction to the extent of minus 1%, I think the market will take it in its stride. And because everyone by this time more or less know that we are in a protracted slowdown, all that it might do is end up putting more pressure on RBI when it meets on 31st of July to decrease the rates. Apart from that, I don't see how this weak IIP data is going to weaken the sentiment in the market.
Sandeep Agle, are you a bit surprised with strength in real estate stocks? Now no one likes them, no one owns them, and they are moving up from strength to strength.
Well, in some cases, yes, but the patterns are suggesting that there is some more upside. But then that some more upside is a trading upside. You cannot take a view that it will run up 40-50% from current levels. Take a view of 7, 8, 10, 12, 15%, nothing beyond that. So they can be a trade for a few weeks or at the most a month or so with the momentum. I don't want to get into, I don't see those kind of patterns emerge where Tata Steel was a great buy at 130 and from where it will move to 700, 800. I don't see that kind of a momentum and I don't see that kind of a built up. So some more upside, which is a trading upside, yes.
So Sandeep Agle, since the current market rally is a strong liquidity driven rally, do you think traders, they should be watchful? They should not carry strong positions, or they should trade light?
Every time we move at a higher level, we moved from 5150 to 5300 over the last 7-8 trading sessions. The risk increases when you are long. Though the trend is up, there is still a risk. So yes, they must be watchful. They should be trading light, especially in view of the fact that none of the big moves are able to sustain. That is the main problem. You have a good bull day, like yesterday, and then you move into consolidation where your stop losses could be triggered. So yes, being light is always a better solution in such times.
Pani, as a fund manager, I'm sure you have a structural position and you have a tactical position. Now, just for the benefit of our viewers, structural position is something which is extremely long term. Tactical position is something which could be for 3 to 6 months. So, Pani, my question is that what is your current tactical stance and current tactical position?
See, current tactical stance is we are a little overweight on the kind of sectors that we think will do better than the market in the next 3 to 4 quarters, which means that we continuously are constructive on banking, IT, pharma, and we continue to avoid high beta spaces such as metal and infrastructure. In this case, I would like to emphasize that the structural position from a 1.5 to 2 year perspective is not very materially different from the tactical position, because we are still not seeing any signs of revival even 2 quarters down the line in spaces such as infrastructure for us to be positive on them and start lapping up.
What about valuations? Funny, infra stocks are available at P multiples which are completely smashed out of shape. Investing is all about buying fear and selling greed.
That's right. We would have been happier to look at these infra companies at these valuations devoid of the kind of debt that they are carrying on their balance sheet. But if you exclude the real estate pack, what you are currently looking at in many of the infrastructure companies, whether they are asset owners or whether they are contractors, is there is a structural slowdown in the kind of order book execution that you are seeing. And that since there is no sign of any rapid decline in interest rates to at least give them a relief on their interest costs, we are not seeing any signs of how they are going to revive over the next 2 to 3 quarters. So as soon as you see some signs of recovery, I think selectively some of those stocks would start getting attractive.